Okay. Hi guys, I hope you are doing well. I hope you see my video and hear my voice. Thank you for joining today's session, because today's session is kind of makeup for Mondays. I had an exam and capstone deadline, rough draft deadline for capstone. In capstone project we had several rough drafts, so therefore it was better to cancel the session. And also we are approaching to the end of the semester. Nothing left, almost nothing left. Also, we have, I don't know, 1 or 2 TA sessions also left. And at the last TA session, Çağatay Mellim will probably be with us. Okay, today we will focus on study question 11 questions, and I will explain you the solver function, not function, solver tool in Excel. This is very interesting and important tool that you should be known. Let me see what you read over here. Okay. So we will first start with study question 11 questions with the explanation in Excel, and then I will explain you the solver tool in Excel. But before switching to the study question 11, I have to talk about the question from the previous TA session. I mistakenly, let me share the file. I mistakenly commented on the question, but after uploading the, oops, that's not. Where is it? Okay. After the uploading the TA session recording, I realized my mistake. Not because study question 11 has 12 questions, 20 questions. Therefore, it is difficult for you and for me to conduct, to cover both. Therefore, 11 is today's objective. Mohammed, I talked to Çağatay Mellim yesterday. I said to him that to do quiz in next week, because it is also not appropriate for me to have your quiz in this week, because I have some things to do. Therefore, I delivered your message and also my opinion to him. He considered, said okay, and I don't know, probably he will do it in the next week. But in any case, be prepared for it. Guys, study question 12. Sorry for that. Study question 12, not 11. Study question 12. Just confuse the numbers. Okay, study question 12. Quiz, as I said, will probably on this week, on next week, possibly in this week. But be prepared in any case. Where was it? Okay. Not exchange rate. only risk and return in study question 12. Before switching to study question 12, I hope you see the screen. There was a question in a previous TA session. We discussed midterm to multiple choice questions. From the first glance, these questions seemed identical to me, and I mistakenly commented on that. They are the same things. Maybe the answer is wrong, but the answer is not wrong because this one is asking for annualized rate, but this one is asking for periodic interest rate. It means that, for example, let me open Excel file. For example, periodic interest rate will be 5,000 minus 4,908 in the brackets divided by 4,908. This is our periodic interest rate. But in order to find for annualized, we just multiplying by 360 over 270. And it is the right answer of this question. 2.5% is annualized rate, and periodic rate is 1.87%. I hope this is right now. So let's start with the study questions 12. The file already created there. Question 1. You are planning to invest in the stock market to the following two stocks, stock A and stock B. You know that the economy can either go in recession or it will boom. Being an optimistic investor, you believe the likelihood of observing economic boom is 2 times as high as observing an economic depression. You also know that following about your stocks. Let's write what's given to us. State of economy. Boom and recession. We have stock A, return A, let me call it return A, and return B. Return A is 10%. In boom, in recession, it is 6%. Return B in boom case, -2. In recession, 40%. Let me check it's true. No, yes, it's true. And also we know that the likelihood of observing an economic boom is 2 times as high as economic depression. So it means the probability of this economy being in the boom is 2 times higher than the probability of the recession. So let me add a new column here, probability. So boom's probability is 2 times higher than recession's probability. So it means 2 over 3 is boom's probability, 1 over 3 is recession's probability, and the summation of them should be equal to 1. Okay. So calculate the expected return for stock A and for stock B. Expected return, ER, for stock A, ER for stock B. We have returns of A and the probabilities. So probability of boom times return of the boom plus probability of recession times return of the recession. This is for stock A. And the stock B the same. Probability of boom times probability of return of the boom plus probability of recession multiplied return of the recession. 12% roughly. So we are done with question part A, calculated expected returns. The next question is asking for the total risk, variance and standard deviation for stock A and for stock B. Total risk. Total risk, let's find variance for stock A. A variance for stock B. Then we have to find standard deviation for stock A and standard deviation for stock B. Let me separate them. Okay. Variance for stock A. We know that the variance is equal to, by the formula, the probability of the boom times return in the boom minus expected return to the power of 2 plus return of the recession, probability of the recession multiplied by return of the recession minus corresponding expected return to the power of 2. This is for variance stock A, and variance for the stock B, the same. Return of the boom minus expected return to the power of 2 plus probability times return of the recession minus expected return to the power of 2. They are for variances. And standard deviation, we know that is the square root of variance. So we have SQRT formula here, square root of means. And for the stock B. So we are also done with the part B. Let's switch to part C. Calculate the expected return on portfolio consisting of equal proportions in both stocks. Equal proportions. So equal proportions, let me write here, AR equal. Let's find expected return of the portfolio for each state of the economy. 0.5 because equal proportions is asked in both stocks. 0.5 times return A and 0.5 times return B. Correspondingly, we can drag down here. Yes, 6%, 40%, and 4%. So what the question is asking, calculate the expected return on portfolio consisting of equal proportions in both stocks. So expected return, let me write ER for portfolio is equal to boom's probability multiplied by boom's expected return on portfolio plus boom's recession's probability multiplied recession's expected return. 10.33 8%. Guys, if you have any questions, right now I can't look at the chat box, so you can ask your question by microphone. I hope it's clear. Or we can find the expected return in another way, because we calculated expected return for stock A and for stock B for each separately. So if we are investing in equal proportions for stock A and for stock B, therefore, in order to find expected return on portfolio, we can easily write expected return from stock A with 50% weight plus 0.5 is 12% weight for stock B. It's also the same as we did before. In this case, we are finding expected return for each state of the economy and then multiplying the corresponding probabilities. But here, we already found stock A and stock B return in both state of economics. So therefore, only the single left is that we have to divide in equal proportions the returns. So expected return on portfolio consisting of 10% invested in stock A and 10% remainder in stock B. ER equal, it's not equal right now, ER 10/90. So 10 in return A and 90 is return B, because yes, 10% invested in stock A. So 0.1 multiplied by return A plus 0.9 multiplied by return B. Okay. Return A, return B. Okay. This is a separate question. AR portfolio port. Let me write on. So this is for equal proportion. This is for 10/90 proportion. The probability, corresponding probability of each returns. Or we can also do like that. We can also do like that. We found the expected returns for each stock. So divide, invest 10% in stock A and remainder in the stock B. The same. And the last part of the question, calculate the variance of the portfolio with equal proportions in both stocks using the portfolio returns and expected portfolio return from answer C. So standard deviation for portfolio, equal proportions, the question is asking. So we find the equal proportions in this column returns. So corresponding probability times return minus expected return of the portfolio times 2 plus return probability times return in the recession minus expected return of the portfolio to the power of 2. So this is variance actually. In order to find standard deviation, just take the square root of it. .957%. That's it. Do you have any questions? Ali, do you see the screen? All is clear. Nothing difficult. They are just formulas. If you know their formulas by heart, then it would be a problem to you. So I hope you don't have a question. In any case you have, please open your microphone and ask. Let's switch to question 2. You are thinking about a portfolio where you put half of your money in stock A and half of your money in the risk-free asset, like a treasury bill. Risk-free asset has a return of 5%. So let me copy the okay, it is the same as the given inputs, the same as problem 1. Only we have a treasury bill, return T-bill. Treasury bill is risk-free asset. It is government security. So return rate 10%, 6%. Risk-free asset has a return of 5% in each state of the economy. So what is the variance and the standard deviation of the risk-free asset? Guys, by definition, risk-free asset is risk-free, so it doesn't contain any risk. Therefore, standard deviation and variance is 0 for the risk-free assets. Standard deviation is the risk. But by mathematically, you can also calculate. Let me write ER. ER for T-bill. Standard deviation variance. The probability of T-bill, let me also find the expected returns. Plus okay, it is the same as the its return. Expected return is also 5%. So in order to find variance of the treasury bill, probability of the boom times treasury bill return in boom case minus expected return to the power of 2, and the same for the recession to the power of 2. So you see it is 0. So therefore, it is not required to calculate the expected return, the standard deviation and variance for the treasury bill. They are 0. We are done with the first question, A's part. What is the expected return on your portfolio? So we are putting half of our money in stock A and half of our money in risk-free asset. $0.5 times This one plus this one. This is our expected return process. We took half of the returns for each asset. Variance of the portfolio. In order to find variance of the portfolio, we are equal. We should find firstly the expected returns for each state of the economy. We are also put our money half in return A and half in stock A and half in treasury bill. Okay, let me convert them percentages. Variance on your portfolio. Variance of the portfolio is equal to Boom's probability times, again, expected return in the Boom's case minus expected return of portfolio to the power of 2 plus the same thing for the recession minus expected return on portfolio to the power of 2. This is our variance. Then what is the standard deviation of the portfolio? Standard deviation is just square root of that. Square root of variance. So that's question 2, the same as question 1. Do you have any question? Anything unclear? Okay, then let's switch to question 3. Economic state, return A, return B, 2 stocks. One's probability is 40%. Economic boom is 40%. Let me copy it down and it changed some variables. So probability of boom is 40%. It means 0.4 and 0.6 for recession. Returns 38%, minus 4%, minus 4%, 6%, and 12%. Okay. Expected return for the stock A and for stock B, the same thing. Expected return for stock A and for stock B. That again, probability times boom plus probability time the recession. Plus this one. Part B, calculate the standard deviation for stock A and for stock B. standard deviation stock A and standard deviation for stock B. The probability times expected return, Boom's return minus expected return to the power of 2 plus recession's probability times recession's return minus expected return to the power of 2. It is variance, so therefore we should take the square root of it with SQRT formula. And standard deviation for return stock B to the power of times 2 to the power of 2 and recession's probability times return for B in recession minus return expected return for stock B to the power of 2. Then take the square root of it. Okay. Then what it says, calculate this total risk standard deviation of portfolio where 1/8 of your money is invested in stock A and the remainder is invested in stock B. Expected return for 1/8 case, let's say that like that. So 1/8 times return A plus 7/8 times return B. And if I drag down here, both of them are 10%, by the way. What he is asking for, total risk of portfolio, ST-def for portfolio, but before standard deviation, we should find those expected return for portfolio, because in the calculation of AR, in the calculation of standard deviation, we need expected return for portfolio. Expected return is probability times 10% plus probability times 10%. It is again 10%. And the standard deviation of the portfolio will be how much you guess. Expected return to the power of it will be 0. If you take also square root of it, because it is standard deviation, again 0. Because expected return for each case, for booms and recession, it is 10%, so therefore it is risk-free portfolio. And the last part, calculate the expected return on portfolio with equal proportions in the risky assets and equal proportions in the risk assets and 30% in risk-free asset. We have to conduct new table return A, return B, and risk-free asset. So the question is asking equal proportions in the risk-free asset and 30% in risk-free asset. Our risk-free asset use your answer in D to find out what the rate of return is on the risk-free asset. So in this question, we found that the portfolio, this portfolio is risk-free portfolio. So therefore, we have to use its returns in our new calculation. Therefore, I copied down its returns. So expected return on portfolio, AR, yeah, let me write it, AR. But first, we should find the expected return for each of the state of the economy. So AR, let me write here, equal AR. So equal proportions in stock A and stock B, and 30% in risk-free asset. If we are investing in 30% in risk-free asset, what we have left with this 70%. So therefore, we should divide 70% into two equal parts, 35% for return A, stock A, and 35% for stock B. 0.35 times return A plus 0.35 times return B, and 0.3 for risk-free asset. Okay, and expected return is probability of boom times return on the boom plus probability of the recession times return on the recession. 10.84%. So we finished the question 3. Do you have any questions? Yes, Ali, we take the percentage of risk-free asset 10% because the question is asking like that. Use your answer in D to find out what rate of return is on stock asset. In D, it should be in C because we found in the C part of the question the risk-free asset, because if the standard deviation is 0% of the 0% in the portfolio, so it means it is risk-free portfolio because standard deviation is 0. Also, its returns in each case, in each state of the economy is 10%, 10%. So therefore, our risk-free asset is that portfolio we used in part C. Therefore, I copied down its returns here. So if you don't have any question, let me continue. It's question 4. Question 4. You are thinking about investing in investing your money in the stock market. You have the following 3 stocks in mind: stock A, stock B, and stock C. You know that the economy is expected to behave according to the following table. You believe the likelihood of each scenario is identical. All states of nature have equal probabilities. You also know that about your two stocks. Okay. Calculate the expected returns for stock A, B, C. Stock A. So let's again conduct table. State of the economy: depression, recession, normal, and boom. Return A and return C, because we have 3 stocks. Let me delete the probabilities. Minus 20%, 10%, 30%, 50%, 5%, 20%, minus 12%, and 9%. Okay. Minus 5, 5, minus 3. Minus 5, 5, 5, minus 3. They are the returns. So the coming to probabilities, all states of nature have equal probability. So we have 4 states of the nature. They have 0.25% for each probabilities. Calculate the expected returns for stock A, B, C. Again, expected return for stock A, B, and C. So, expected return of stock A. Guys, we see that all the probabilities are the same. So therefore, I can easily write like that: 0.25 times the summation of all the returns of the A. Let me copy it down. This is for B, and this is for C. This is part A. Calculate the total risk for the stock A, B, C. Again, stock A and B, C. $0.25. Let me write like that. Return A in depression minus expected return to the power of 2 plus, again, probability times this one to the power of 2 plus normal return minus expected to the power of 2 and plus 0.25 times 50 minus to the power of 2. They are standard deviation. We take square root of them. Let me fix the cells, probabilities, and drag them down. This is for B and for C. Standard deviations. We also calculated them. So what is the expected return of the portfolio with equal investments in stock B and stock C? Expected return B and C. So we are investing in B and C, not A. And with how is that, equal investments. So if you are investing in equal, summation of them. Okay, 0.5 summation of them, right? And expected return on portfolio, AR portfolio, B and C. Probabilities are also the same, so 0.25 times summation of all of them, 3%. D, what is the total risk of the portfolio that's equally invested in 3 stocks? Equally invested in 3 stocks. I delete the B and C part. So and copy down here. If we are equally investing in 3 stocks, so it means 1/3 for A, 1/3 for B, and 1/3 for C. Therefore, for the sake of simplicity, let's write summation of all of them over 3. Why we divided 3? Again, I see because we have 3 stocks and we are investing equally in these 3 stocks. So returns, expected return for portfolio is 0.25 times summation of all of them. This is expected return, and then we can easily find standard deviation for the portfolio, because in order to find standard deviation, firstly we should find expected return for the portfolio. Expected return 0.25. Let me actually copy this formula. It is for it's here, here, here, here, and here. Guys, 1 minute. Okay. Qrup yoldaşı mesaj yazmışdı. Capstone'la bağlanıyorum. What is that? It's not B. Should be B. Yes. Səni kopya eləyəndə bunlarda səhv refer olunmuşdu. Ona görə onları düzəltdim. Standard deviation is 9.25%. And how can you tell that you have improved your risk-return trade-off relative to the individual investments in A, B, and C? Guys, you have, which part is in it? I think it was the first part, risk-return trade-off part. We covered, actually you covered, coefficient of variation. Standardized measure of the dispersion about the expected value that shows the risk per unit of the return. So the question is actually asking for the coefficient of variation for individual investments and also in the portfolio investments, risk return trade-off. Coefficient of variation shows how much risk you are taking per 1 unit of return. Because we are dividing standard deviation over expected return, this coefficient of variation shows how much you are how much risk you are facing with in per unit of return. So therefore, let's find coefficient of variation for stock A, stock B, C, we don't need it anymore. Okay. Stock A, stock B, and stock C. By the formula, it is standard deviation over expected return. Wow. Okay. Okay, they are true. Then for portfolio B and C, and coefficient of variation for portfolio, not B and C, for all the portfolios. It is standard deviation over expected return number. And for this one, we should calculate expected return standard deviation of standard deviation for portfolio port B and C. Okay, standard deviation is equal to 0.25 times expected return of them minus expected return of portfolio to the power of 2 plus again minus expected return to the power of 2 plus normal probability to the power of expected return of BC in normal case minus overall expected return, and to the power of 2 plus expected return multiplied 3% minus 3% to the power of 2. And it is variance actually, so therefore take the square root of it because we need standard deviation. So coefficient of variation is equal to standard deviation for portfolio divided by expected return on portfolio. Hello. So let's look at them. We see that in stock A, for the 1 unit of return, we take 1.48 unit risk. For stock B, it is higher, very high, 2 unit. For 1 unit of return in stock B, you should take 2.09 units of risk. In stock C, it is very bad because for 1 unit of return, you should take 9 units of risk. In stock portfolio B and C, it is less than actually others, but not A. But coefficient of variation of portfolio, I mean, for all the stocks in the portfolio, it is very less. So it means that if you increase the number of stocks in your portfolio, or in other words, if you are diversifying your portfolio, the risk is shared between all the stocks. So if, for example, one stock is doing bad, other stock can do well, risk is compressed. So therefore, coefficient of variation, or other case, 1 unit of risk per 1 unit of return is less than others, at least less than in all portfolio than others. So we improved our risk-free, I mean risk-return trade-off relative to stock A, stock B, and stock C. So if you add stock D here, for example, and calculate stock portfolio coefficient of variation for portfolio for all the 4 stocks, it will be less than 1.18 actually. Is it clear? Gatay, what you said, can you show again how you found the portfolio return rate? No, it's just taking average. Portfolio return. Just took average. Do you have any questions? So it seems you don't have. Let's start the 5th question. Using the CAPM and security market line, what's the expected rate of return for investment with beta of 1.8, risk-free rate of return of 4%, and market rate of return 10%? That's very easy question. So we have beta 1.8, risk-free rate 4%, market return 10%. So our expected return according to KPM is risk-free rate plus market rate minus risk-free rate multiplied beta. Because we have KPM. KPM says expected return is equal to RF plus risk-free rate plus market rate minus, again, risk-free times beta. So that's question 5. It's easy question. Let's switch to question 6. You know that an investment with a beta of 1 generates expected return of 9%. You also know that another investment has beta of 0, generates a return of 2%. What return can you expect on investment with beta of 0.75? 75. That's very interesting question. Let me write investment. We have 3 investment: investment 1, investment 2, and investment 3. So we have risk-free rate. Let me ensure this. We have RF, we have RM, risk-free rate, market rate, beta, and expected return. So what we have, investment, a beta of 1 generates 9% return. Beta 1 generates 9%. Beta 2, investment 2, has beta of 0, generates 2% of return. And what return can you expect on an investment with a beta of 0.75? So the question is asking for that return. From the KPM formula, we see that if beta is 0, this part becomes the 0, and we are left with only risk-free rate. So our expected return becomes our risk-free rate. Therefore, put 2% here. It is the same. So if risk-free rate is 2%, it is also 2% for others, because risk-free rate is the same for all of them. Market rate. If risk-free rate is 2%, beta 1, if beta is 1 in investment 1, so expected return is RF plus RM minus RF. RFs are cancelled out, only we left with RM, with market rate. So our expected return on investment 2 is equal to market rate. So therefore, our market rate is 9%. So it is 9% for all of them. 9% for all of them. So we can easily find the expected return for investment 3. 2% plus brackets risk-free market rate minus risk-free times beta. 7.25%. Is it clear? Yes, it means risk-free rate is 2%. Biz məsələn nə etdik? Təkcə bunlar verilmişdi. KPN formulasının köməkliyi ilə birinci risk-free rate tapdıq. Sonra hamısı risk-free rate hamısı üçün eyni olmalıdır təbii ki. Çünki risk-free rate bir dənədir. Market rate də təbii ki bir dənədir. Sonra market rate tətbiq elədik. Və salam boşluqlarımızı doldurduq. And we've calculated expected return for investment 3. Question 7. You are forming a portfolio where you put a quarter of your money in small stocks with a beta of 2.8, half of your money in large stocks, 1/8 in well-diversified portfolio like S&P 5 index. Guys, S&P 5 index is index for USA stock market. That's very popular index in the stock market. So if you want to find out what's happening in the USA market, just look at the S&P 500 index. So if S&P 500 index is up, so it means stock market is up, or if it's down, it means stock market is down. S&P 500 means 500 big market capitalized embraces big market capitalized companies. 500. 500 dənə kompaninin özündə birləşdirir. 500 dənə ən böyük market kapitalizasiyana malik olan şirkətdir. Daha doğrusu indeksdir. Və buna bəzən blue chip kompanilər də deyilir. İndi özünüz əlavə research eləyərsiniz. Blue chip nədir? Ən məşhur indeksdir. And 1/8 of money in risk-free T-bills. Let's form our portfolio. Stocks, let's say we have small stock, large stock, S&P 500 stock, this index, risk-free T-bill. We have weights, then what we should have, beta, and expected return. Weights. Quarter of money in small stock. Quarter means 0.25. Half of our money in large stock. 0.5. And 1/8 for S&P, 1/8 for risk-free. 0.125 for this and 0.125 for this. The summation of them should be equal to 1, yes. And the betas. Small stock has 2.8 beta, big large stock 1.8. S&P's beta should be equal to 1. Why equal to 1? Because S&P, it is market index. It is the market. So market should be equal to itself. Therefore, its beta is equal to 1. And risk-free rate T-bill 0 beta because risk-free rate or treasury bills has nothing to do with the market. Market, regardless, market is up and down. Risk-free rate will have constant rate. Therefore, its beta is 0. But S&P 500 index is our benchmark. So therefore, it is market rate. Also, because it indicates the market, therefore its beta is 1. And they are the stocks relative to S&P 500 index. It's return 18%, 13%, 9%, and 4%. what we are required to do, expected return and systematic risk, or beta. AR for portfolio and beta of portfolio. Portfolio. So just take their weighted averages plus this one plus this plus this one plus this plus risk-free rate weight. This is expected return for portfolio. And expected return, a beta for the portfolio, is again weighted average of all betas plus we're done with this question, 7th question. So do you have any question? If you don't have any question, let's take 15 minutes of break. Then come back after 15 minutes. What is the time? 18:58. 19:15-də burada olun. Sualların davamını eləyək. Artıq çətinlər, yəni vaxt aparanlar buradaydı. Bunlar qutardıq onlarla. Bunları qurtaraq, sonra sual verib, izah eləyim sizə, gedəsiniz. 19:15-də burada olun. I hope you're here, guys. Vaxt itirmədən davam eləyək. I'm sharing the screen. Okay. We're done with question 7. Let's continue to question 8. Stock A has an expected return of 14.05% and beta of 2.2. Stock B has an expected return of 7% and beta of 1. What must be the expected return on risk-free asset? Question 8. We have stock A and stock B. Then we have RF again. Let me copy them from here. Stock A has beta of 2.2 and expected return of 14.05%. Stock B, beta 1 and 7%. 7%. Let me copy down also KPM formula here. So we should find RF, risk-free rate. The question is asking for expected return on risk-free asset. This is our risk-free asset rate, RF. Look at the stock B. If beta is 1, so it means brackets are opened, expected return is equal to RF plus RM minus RF. So expected return is market return. And also by definition, as I said, if beta is 1, it means it is market index, market stock, let's say, because it has beta of 1. So expected return is as the same as risk market rate. So it is 7%. It means it is also 7%. The market rate is same for all. And risk-free rate. Risk-free rate, you can find like that. Expected return minus market rate multiplied by beta divided by 1 minus beta. It is also true for this. What I did here, I just solved the equation for the RF. So therefore, burada bir qəribə bir formula alındı, amma yəni RF-ə görə bunu həll eləmişəm. So our RF is 1 point risk-free rate of return, 1.125%. I hope it's also clear. Okay. We don't have a question. So, ninth question. A recession is an economic event that's best characterized as recession happens in the market. So, recession is in the market. It affects all the firms, companies that are currently in the market. Unsystematic risk that can be diversified away. Recession has nothing to do with unsystematic risk because unsystematic risk is firm-specific risk, the risk that belongs to related to only a firm. For example, company A has financial disabilities. It doesn't have strong financial condition. It has huge losses. credit worth is less. Its rating, corporate rating, bond rating is also very less. But company B, vice versa, strong financial condition, strong financial cash flows. So therefore, company A has a risk of default or risk of something. But what can company B do? Nothing, because it is related to, it is his risks. It has nothing to do with company B. So therefore, unsystematic risk, that's called unsystematic risk. Therefore, unsystematic risk has nothing to do with recession. It is firm-specific risk. Systematic risk. It is our true question, answer, because systematic risk is market risk times beta, or we can say it is systematic risk is market risk, relative the risk that comes from the market, and we are multiplying it by beta. So if recession happens in the market, not all the companies will the same of level of the risk, because, for example, the beta of company A, let's say, is 0.5. The beta of company B is 1.5. So the beta of the company A less than company B. Therefore, recession, company A will face less recession than company B. B is our correct answer, systematic risk. C, market risk can be diversified away. It is not market risk, because market risk, we cannot diversify market risk. It is the total risk for the market. Unsystematic risk, it is also firm-specific risk, nothing to do with the recession or all the market. So therefore, our true answer is B, systematic risk. I hope you understand your mistake. Do you have any concerns? Okay, it seems you don't have. Question 10. Stock A has a beta of 1.2 and stock B has a beta of 0.6. Which of the following statement is true? Stock A, more unsystematic risk than stock B. We don't know unsystematic risk because it is firm-specific risk. Beta has nothing to do with unsystematic risk. So therefore, A is not true. B, stock B has more systematic risk than A. Actually, stock B has less systematic risk because stock B's beta is 0.6, but stock A's beta is 1.2. C, if the risk-free rate and the market risk premium both positive, stock A has higher required rate of return than stock B, according to KPM. That's the true answer. Because let's look at the KPM formula. If risk-free rate and market rate is the same, only the varying thing input is beta. So if you increase the beta, expected return will also increase. Therefore, C is our correct answer in this case. Question 11. Consider a stock with a beta of 1.5. Which of the following statement is true? So a stock has a beta of 1.5. When the market goes down by 1.5%, on average, the stock goes down by 1%. That should be reversed. when market goes down by, it should have been like that. But when market goes down by 1%, then it means stock will go down by 1.5% because the stock has a beta of 1.5. So therefore, A is not true. It should be reverse. 1 is here, 1.5 is here. When market goes up by 1.5%, on average, the stock goes up by 1%. It is also not true because the market stock has beta of 1.55. So therefore, it should be market goes up by 1%, the stock goes up by 1.5%. When the market goes up by 1% on average, the stock goes down by 1.5%. That's also not true because we have positive beta, not negative beta. In the negative beta case, yes, it's true. Because if company has a stock of beta of minus 1.5, so it means if the market goes up by 1%, it means company stock will go down by 1.5%. Coming to D, when the market goes down by 1% average, the stock goes down by 1.5%. That's our correct answer because we are multiplying 1.5 with the market rate. Is it clear? Okay. Which of the following statement is true about the market risk premium? Market risk premium is market expected return minus risk-free return. You know that. Market risk premium is defined as the expected return on the market portfolio minus risk-free rate of return. That's our true answer. And the market return, expected return on the market portfolio, read the question correctly. This is not expected return of the stock. Market, it is market. Minus risk-free rate of return. Let's look at the B. Market risk premium is defined as the risk-free rate of return minus expected return. It's not true. It should be market expected return minus risk-free, not vice versa. C. The market return is defined as beta multiplied by expected. We don't multiply beta by market return. Instead, we multiply beta by risk premium, market risk premium, which means RM minus RF. So only A is true in our case. Question 13. The expected return on the portfolio, market portfolio, expected return on the market portfolio is equals 12%. Risk rate is 6%. Required return on stock with beta of 0.3. That should be question 13. So we have market return. %. Risk-free rate 6%. Beta 0.66%. 0.66. Okay. Expected or required return of the stock is equal to risk-free rate plus market minus risk-free times beta. That's the easy question. We are referring here to the CAPM formula. So question 14. Suppose that risk-free rate is 3%, market risk premium is 8%, market risk premium is 8%. It is not market return. It is market risk premium, which means 8% is already RM minus RF. According to CAPM, what's the required return on stock with beta 2%? It should be 2, not 2%, because beta is not presented in percentage terms. So market premium 8%, 8%, risk-free rate 3%, beta 2 is 2, and required rate again, rate of return is equal to, no, because their inputs are different, risk-free rate plus market premium multiplied by beta, 19%. That's also easy question. Question 15. Required return on particular stock is 14% according to KPM. The stock beta is 1.5%. Risk-free rate is, what is the risk-free rate if the expected return on the market portfolio equals 10%? So stock required return is 14%. Beta is 1.5. Market return is 10%. Is 10%. We should find risk-free rate. Risk-free rate is equal to the required rate of return minus market return times beta divided by 1 minus beta, 2%. I referred the formula of KPM again, nothing different, just solve the equation for RF. So in order to check the correctness, we can also market return minus risk-free times beta, 14%, the same. Question 16. You analyze the prospects of several companies and come to the following conclusions about required return on each. Stock required return. So we have stocks of Starbucks, Sears, Microsoft, and limited brands. We have required return. %, 8%, 16%, and 12%. 18, 8, 16, 12. So you decide to invest 4,000 in Starbucks, 6,000 in Sears, 12,000 in Microsoft, and 3,000 in limited brands. What is the required return on your portfolio? Investment. Our investment, let's say, $4,000 in Starbucks, 6,000 in Sears, 12,000 in Microsoft, and 3,000 in limited brands. They are presented in dollar terms. What we are looking for, required return of portfolio, In order to know, to find required return on portfolio, we should know firstly the weights. But we don't have weights, instead we have investments. So from these investments, we can find the total investment that we are making and divide each investment amount by the summation of them. And from there, we will extract the weights. So weight is 4,000 over summation of sum of all of them. Let me fix the cells. Okay, their summation is equal to 1. So in this case, we can easily find required return of the portfolio plus this. Certain 0.92%. Is it clear? Question 17. Okay. A company A stock has a beta equal to 0.9. Company B stock has a beta of 2. What's the beta of portfolio invested equally in 2 stocks? Very easy question. Beta A, beta B, (0.9) beta A and 2 is beta 2. So what's the beta of portfolio? Beta of portfolio with equal investments. Sum of them divided by 2. I mean 0.5 multiplied by this, or 0.5 multiplied by this is the same as this one. So it is a question. We have left with three questions. You have the portfolio that consists of 35% XYZ stock, 35% ABC, and 30% of QVA. Stock XYZ, stock ABC, and stock QVA. Weight, beta, and expected return. Weight, RF. Let me copy it from here. Okay. The weight of XY is 35%, 35 for ABC, and 30% QVA. 0.35, 0.35, and 0.5. Treasury bill currently offers a return of 4%. So risk-free rate is 4%. Expected return on market is 11.5%. Beta 1, 3, and 0.5. 1, 3, and 0.5. We should find expected return on portfolio. So firstly, let me find the expected return according to KPM formula plus risk RM minus RF multiplied by beta. Okay. And expected or ER for portfolio is equal to weights, corresponding weights with their returns. 0.5 multiplied by 7.75. Okay. It is clear, I guess. Question 19. Why the last weight is 0.5? I'm sorry. It should be, yes, 30%. It's my bad. Sorry for, thanks for reminding me. F144, başka səhv yoxdur yəqin ki. Aha. Question 19. Suppose you hold a portfolio that consists of 35 XY, 35 treasury bill, and 30% QY stock. Again, the same. Let me copy down the formula here. We have XY treasury bill instead of stock ABC. We have treasury bill. 35, 35, 30. XY has beta of 1. QVA 0.5. And risk-free rate beta should be, treasury bill beta should be 0. It's, of course. Expected return on market is the same. 4% is also the same. So we can calculate easily. Okay. The corresponding formula is generated. 7.75%. I hope it's also clear. And the last question. I will explain the solver on this question. Solver is not big thing. It's not big deal, but anyway, I will show you. So you have 20,000. Let me see if you have no questions. You have $20,000 to invest in stock portfolio. So you have money of 20,000. Then your choices are stock A with beta of 2, stock B and beta of 0.5. 0.9. Risk-free rate is 3%. Expected return on the market is 9%. Your goal is to create portfolio that has an expected return of 13.86. So how much money do you need to invest in stock A and B? So we don't have weights actually. We will find the weights from the formula. And we should invest in our money in a weight that our aim is reached. Target expected return of portfolio should be 13.86. So let me copy down the formula here. I mean, copy down the we have stock A, stock B, stock B. We don't know weights here. Risk rate is 3%. 3%. Market return is 9%. Beta. Stock A beta is 2. Stock B beta is 0.9. 0.9. And corresponding expected returns. So our expected return is 13.86%. We know that expected return formula, ER, guys, look at here carefully. ER is equal to weight of A multiplied by return of A plus weight of B multiplied by return of B. We have expected return, target expected return. We have return A and we have return B. So you can also switch, substitute the formula, I mean substitute weight A, weight B with 1 minus weight A, because sum of the weights should be equal to 1. Therefore, we substitute weight of B with 1 minus weight of A and solve the equation for weight of A. Then subtract from the 1, you will find the weights. But let's do like that in solver, with solver. How to do it with solver? Let me delete it. Insert again cell. We know that expected return should be weight multiplied by expected return plus weight of B multiplied by expected return of B. It is currently 0 because we don't have weights. And we know that weight of A plus weight of B should be equal to 1. We set up our formulas and for expected return and total of weights. We can apply solver function here. Solver in the data section of the Excel. If you don't have it, just if you are using Mac, from the tools bar, come here to Excel add-ins. It is checked for me, but it should be unchecked for you if you are using for the first time. Check all of them and click OK. If you are using Windows, I don't know how it should be in Windows. Let me see how to add solver to Excel. It shows the step on Windows, so do it like that. Anyways, I have solver here. Niye böyle oldu? Dakika. Okay. Come to solver. Setting objective. Our objective is expected return. This expected return to the value of 13.86%. So we are giving Excel a command of that. Please set our objected cell expected return to 13.16. How? By changing variable cells. Our changing variable cells is our weights. So Excel solver will allocate weights in order to get 30.86% expected return. Also, we should add some constraints here. One of the constraints is total weight should be equal to 1. Because Excel bəlkə başqa weightlər də verə bilər. Yəni onu biz formulaya əsasən vermişik ki, bu ikisinin cəmi budur və bu da 1-ə bərabər olmalıdır. Ona görə weightləri nizamlasın. Then stock A weight should be less than 1. Also, stock B weight should be less than 1 because we don't want to weight 1. Çünki ola bilər Excel buna 1 verəcək, buna 0 verəcək. Və bu da təbii ki, cəmi 1 olacaq. Yəni biz bunu istəmirik. Ona görə constraintlərimizi add edirik. Add elədik, cancel. Objectivimiz var, changing celllərimiz var və let's solve. See what happens. Excel found the solution. I mean, solver found the solution. You see, 0.8 should be allocated for stock A, and 0.2 should be allocated to stock B. Our expected return is targeted to 13.86. It is very useful tool, by the way. So that's all about solver. Is it clear? Gəlin sizə bir şey də göstərim. Solverin tətbiqinə aid. Solver. For example, we have stock A, we have stock B, we have stock C, we have stock D, we have SAP 500, and we have risk-free, free asset. So they give us returns. For example, these returns: 30% return from stock A, 20% return from stock B, 24% return from stock C, 18% return from stock D, 10% return on the SAP, and risk-free gives us 7%. We have also weights. But we don't have weights. We don't know weights. And our target expected return. Let's say let me add the, let me write here, target 22%. So I want to gain 22% portfolio return from all these assets, but I don't know how much should I invest in these weights, in stock A, in stock B, and stock C, D, S&P 500, and risk-free asset. But we know that these weights should be, sum of the weights should be equal to 1. And also our target expected return is calculated by corresponding weights with corresponding returns. This 24%, this 18%, this 10%, this, and 7%, this. It shows 0 because we don't have weights. So we can apply the solver function here. So our target is B10. B10 to the value of, what value we are looking for? 22%. So Excel should allocate 22% by changing these weights. Then we should add constraints here. This should be less than 1, add, and also greater than 1, greater than 0, because weights are between 0 and 1. Add it. This one also less than 1, greater than 0, less than 1, greater than 0, stock D less than 1, greater than 0, SAP less than 1, greater than 0, and risk-free asset less than 1, greater than 0. And one more constraint, our weight, sum of weight, should be equal to 1. They are correct. Okay, so we can easily solve our equation. Let's see. Excel found the solution. So our weights should be allocated in that way. Very interesting. I mean, tool and useful tool, and our target expected return is the same as our target, 22%. So we should allocate our weights like that in order to get a target expected return. So we found weight of weight of A and weight of B, then we can easily find investment. Yes, Rafael, I will send you. I will send you. What's the question? How much money do you need to invest in stock A and stock B? So stock A, investment, and stock B, investment. How much money you have? 20,000 multiplied by stock A, weight of stock A, and 20,000 multiplied stock B. 16.000 16.000 A'ya, 4.000 B'ye invest edəcək. bizim expected return'ümüz target bu olacak. That's it. Do you have any questions? Thank you for being with me. I hope I explained all the questions very well and you understand also them. And practice solver one more time. Solver is very useful function and very useful applications. So see you probably in next week or next week after the next week. I don't know in which week last day session will be conducted. See you. Bye bye.